Hi, everybody. This is Esther Goulias, the tax lady from EG Tax. And of course, I'm joined in studio with Chris Fabian. Now, today we're going to do, because of the one big beautiful bill that was just passed, we thought, we've gotten some emails on the subject. And usually when we're doing the radio show, we don't have time to really chew it up. But I thought this might be interesting. So we're just going to do emails today. So next week, we'll be taking your phone calls. And, on that subject, quite frankly, we have a free seminar that you can come to, bring a copy of your tax return, and we will actually go through the one big beautiful bill and show you how it'll impact your taxes and maybe make some suggestions, because this is a great opportunity for you to take money out of your pension or IRA and do it for free. So without paying taxes, of course. So, but anyway, Chris, how are you doing today?
Hello, Esther.
Hello, Christopher. All right, so we're going to do emails, right?
We're going to do some emails, and don't forget also our school's going to start in a
right.
month. So if you're interested in learning about taxes and potentially getting a job, doing taxes, give us a call. We got the free course. You do have to pay for the book. It's not much. You'll learn a lot and be the hit of the party, right, Esther?
I'm going to tell you, it's remarkable that people really have no idea how they're taxed. And, it's like the biggest expense in most people's lives. And it's so important because it really predicates, am I going to borrow the money or take the money out of my 401k plan? Should I borrow the money against my 401k? Should I take it out of my IRA? Should I put money in? I mean, all these kind of things really impact your life. And what's so great about our tax course, you really learn taxes.
That's right.
Yeah. So anyway, how do they register?
They can give us a call, 632-7886, or go right to our website at egtax.com, and that's for both the school and the seminar.
And the seminar, right.
Yep.
Which I think, and the changes coming down the pike, most of them are retroactive. So a lot of people think, well, they just passed the law, it won't affect till next year. Not true. So, there's things you can do this last quarter that can really, not only are you going to save money because of the big, beautiful bill, but you're also can kind of make some things happen, like energy conservation, right?
That's right. There's still time to do the energy. That actually, that's the big one right now. That ends this year.
Right, December 31st.
December 31st is the last time.
And
it's got to be
with the EV credit,
Yep.
that great big $7,500 credit.
Yeah, the EV credit ends at the end of September, end of this month. You have to have it, and it has to be placed in service. It doesn't mean you order it by September 30th and you pick it up in the middle of October. You have to have the new car in your possession by September 30th. And the same thing with the windows and the doors, the furnace, air conditioning. I don't know who would do an air conditioning unit in December, but you may want to.
You do if you're going to save $600.
Right. Yes.
Okay, let's do our first email. What do we got?
Sure. Gwen writes in, I have not itemized in years, but this year I may be able to qualify. I have income of approximately $90,000 from wages. I own a home with property taxes of $9,000. My New York withholding is $8,000. I give around $1,000 to charity, and my mortgage interest is $4,000. If I do new windows, will that help too? I'm single. Can I make it this year?
Okay, well, yeah. So her standard deduction is, let's say, $16,000. That's close. We'll just use round figures, $15,750, I think. Anyway, so in order to itemize, you have to beat the amount that they're going to let you write off anyway, and that's called the standard deduction. Now, she doesn't say she's over 65. She's over 64. No. So the only thing that would increase her standard deduction is if she was over the age of 64, because she'd get another increase to her standard deduction because she's over 64. So assuming that she's not, and her itemized deductions basically, when I cipher everything, comes to 22,000. So that would be her itemized, and that since that's more than the standard, yes, she'd get to itemize on the federal and the state.
Right, right.
And then her windows, right? You can tell her about her windows.
Yeah, because, well, let's see, 17, 20, 21, 22,000 would be her itemized deductions.
Right.
That would bring her down to 68,000. So yes, the windows will help, and that would give you up to a $600 credit there. So overall, you know, you're going to save the 600 plus the extra 22 minus 16, 6,000 at 20%, another 1,200.
$1,200,
It's about
right.
$1,800 on the federal.
Right. And that's money you don't pay in.
Yep.
So if she was sitting home thinking, oh, I don't know if I should itemize, and she just took the standard deduction, she would pay an extra $1,200 in taxes. And if she didn't do the windows, she would pay an extra $600. So she'd pay an extra about $1,800 if she didn't itemize and didn't do the windows. You know, and the IRS is not going to call her up, Gwen up, and say, oh, by the way, I think you could itemize this year. One of the things that happened under the One Big Beautiful Bill that made this happen was what was lifted, Chris?
The salt.
Right. And we don't mean salt and pepper. We mean state and local taxes that were limited to 10,000. Because if this was 2024's return for Gwen, she wouldn't be able to deduct her. She would be limited to $10,000 in her taxes. Well, under the One Big Beautiful Bill, it's now limited to up to $40,000, and there's an income cap as well for if she were highly compensated. But in this case, with her property taxes of 9 and her state withholding of 8, that's 17,000. Last year she could have only done 10,000, right?
Correct.
So she's going to, her extra hit is from that big beautiful bill, the itemized deduction.
Right, right. And, you know, she does say she hasn't itemized in years. Hopefully she itemized on New York
On the
State,
state.
because she could have been, if she thought, well, I don't itemize, I don't need it, I'm not going to worry about it, she could have lost money on New York State. So
But what can she do?
she can do an amended return and get some money back from New York if she didn't take advantage of that.
Right.
So,
So that's cool.
yeah, definitely give us a call. We'd love to help you. You know, that's what we do. We like to help people. We want to make sure their money.
I was with somebody yesterday and I said, you know, I get more excited about saving taxpayers' money on their taxes, I think, than they do.
Yep. Yeah.
Because it's like earning my keep, so to speak. I love it when I think to myself, I just saved them $500. And they may not know it, you know, because many times people judge what we do based upon the size of their refund, right?
Right.
And if let's say they're going to get an $8,000 refund, but they could get 10, they're just happy with the 8. But see, I think to myself, I want you to get 10.
Right,
You
right.
know? And by doing certain things, that happens.
That's right. Yep, yep. And how many people out there penny pinch to save that extra couple $100 when all they have to do is a couple other little things, and it's not hard at all.
Right, absolutely. Anyway, I'm Esther Gillius, the tax lady, in studio here with Christopher Fabian. We're doing emails today. I encourage you, if you do have any questions about your taxes, you can call us at 632-7886 or go to our website at egtax.com. Ask the tax lady. I'll be happy to answer your tax questions. We're going to take a short break. We'll be back on the other side with your emails. Hi, I'm Esther Gillius, the tax lady from EG Tax. We're talking emails today. It would encourage you. Understand the One Big Beautiful Bill passed. There are things that you can do in this fourth quarter that will get you even a better refund, lower taxes, if you avail yourself of some of these changes. So that's part of what we're doing. We're trying to help people with their emails. And of course, Chris is in charge of what we got here for emails. And so what's the next thing, Chris?
Sure. This is one that would impact a lot of people. I'm in the hospitality industry. As such, I have wages of $75,000, of which $20,000 is from tips. I am single. Do I get a deduction for this?
Well, this is an easy one. These are one of the things that you don't have to do anything about it. You get it. And so being in the hospitality industry, that is a normal tipping industry. And so that's part of what the qualifications are under the One Big Beautiful Bill, is that if you are getting tips, it has to be something that you would have normally gotten tipped on, right? You just can't just exclude something because you say, I'm going to start getting tips. They've changed my salary structure. So the first $12,500 in tips that this taxpayer gets is going to be tax-free.
Right.
That's
right.
it.
Right. Well, the thing is, they have to pay Social Security and Medicare on it,
Right.
but
That's all done through their employer.
That's done through their employer. So it's not totally tax-free. It's income tax-free. So you'll save some good money there. But this leads into...
All right, now what happens on New York State?
Well, I was just going to say, this leads into a question from Eric. Is New York State following suit with the BBB? Also, is New York State increasing the Empire Child Tax Credit?
Okay, so this is a double. So first of all, New York State is not following suit, right? So you, on the state of New York, you're going to have to add back whatever you subtracted on the federal for your tip income, and it's up to 12.5. So if you got tips of 5,000, that's all that you're going to be able to deduct, right?
Aw, yes. Yep. What you got up to the 12.5.
Right, and if you were married filing a joint return, it'd be up to 25,000 rather, right?
Yes.
And then the Empire State Credit has increased, provided that you have a baby. So if you have a child under the age of 2, then you can get $1,000 additional $1,000 Empire State Child Tax deduction. And so, but it has to be under 2 or under, right?
Yep. And the nice thing, those are, for New York State, the Empire Child Tax Credit is a refundable credit. So if you
Which means that you get the money back.
Yes. Yep. So
even if you pay zero taxes.
Right. So the big thing here is that New York is not following suit with the BBB. So the tips, the overtime.
And a lot of these changes, they're just not going to.
Yep.
They're not going to allow. So.
I mean, so I know.
But let's face it, the big liability is from the federal.
Correct. Yes.
Right?
Yes. And
okay.
I'm sorry. I was just going to say too is we don't know. The federal is that we talked about this at the first segment. The energy credits are going away on the federal side. Well, New York State may still keep their solar credits. We don't know.
They're going to. I mean, based on everything I see, that they're going to. New York State is really in there for this energy stuff. So even though you might not be able to take it on the federal, some of the more advanced, like the solar credit, is still going to be in there.
Yep. So.
Okay. All right. What else we got, Chris?
Bob writes in, with the change in the BBB, my wife and I will get another $12,000 in write-offs. We have pensions of $60,000 and Social Security of $50,000 between us. Will the BBB really help us? We don't have stocks or bonds. We only have an IRA of $40,000 that we haven't touched.
Okay.
So
you got all the numbers there. So they're over the age of 64. Right?
It doesn't say, but we'll say yes.
because they're getting Social
They're
Security.
getting, well, yeah, it says they're going to get another 12,000 in write-offs. So.
Okay, so, and that's 6 and 6.
Yep.
Well, let's clarify that, because maybe they think they're going to get 12 because they're on Social Security, but that's not correct, is it? Because there are strings tied to that $6,000 deduction.
Right.
Their age, they have to be over the age of 64, and their income.
Correct.
So if their income were over 150,000, they wouldn't get the 12 either.
Yes. True.
Right? So, but obviously they're saying their income is lower than that. But that's one of the things I wanted to make sure people understand. When politicians say statements, and our president, Trump, says that there's no tax on tips. There's no tax on tips, no tax on overtime, and no tax on Social Security. Those three things, that's not true. Right?
Correct.
It's close. It's like horseshoe and hand grenades. It's close, but it really isn't correct. So the tax on tips is going to be limited to the first 12.5, right? 25,000 if you're filing a joint return. Same thing with overtime, 12,500 and 25,000 if you're filing a joint return. And for Social Security, is there anything directly tied to the Social Security non-taxability?
Wait for the
Question.
Yeah, I know.
Mark.
Sorry, I was doing math while you were.
Okay, so there isn't. Seniors over the age of 64 are going to get the extra 6,000 apiece, up to 150,000 in income, but it isn't directly tied to Social Security. It is a subtraction that you get to use, which then usually reduces your Social Security. But if you are in the high enough income, you get enough from a pension, for instance, it's not going to affect your Social Security necessarily at all. Just the subtraction.
Right.
Because you could still be paying 85% taxable on that Social Security, but it's still obviously better than nothing. But still, seniors are still going to pay taxes on Social Security.
Right. And if they haven't, the thing is too, they're getting that extra 12. If they are in between 65 and they haven't touched their IRA yet, so I'm assuming they're not 73 yet, they could almost take out $12,000 a year for the next 3 years to close out that IRA, pretty much, and still pay no more in taxes than they did in previous years because they got that extra standard deduction.
Right.
They could convert it to a Roth.
But here's the thing, like you said, in previous years. So you're still going to pay the taxes if you take that out, right?
Mm-hmm.
But you're not going to see a big benefit of that 12,000. Like, for instance, if they didn't take it out, and they on that 12,000, if they were in the 12% tax bracket, they would save $1,440. What you're saying is utilize that $1,440 and put money into a Roth, right?
Right.
Move it to a Roth, and thereby you kind of skinned the cat.
Yep. Yeah, because in 2028, tax laws could potentially change again.
Well, they will.
Yeah.
They will. And as they phase in this stuff in 2026, there's even more changes coming down the pike.
Right.
So these are the
exactly.
changes we're talking about that affect 2025's tax return, but in 2026 there's other things coming down the pike. So that's the challenge of the senior. The computation is still going to be the same. It's half of your Social Security added to your taxable sources of income. You come up with a total. If it's over 32, then it's half taxable until it gets to 85% taxable. And from that, then, when you put all that together, then you get the $12,000. That's 6 and 6 if you're filing a joint return. If you're just single, it's 6,000.
Right. And this is where we always say seniors have that wiggle room. They could take extra money out and not pay taxes. Because if they're like, this person does have a nice pension of 60,000, but if they only had their Social Security of 50,000 and they had 500,000 sitting in a 401k, an IRA somewhere waiting to be 73, they could be taking out about 20,000 a year and still pay no taxes.
All right, and so here's the thing. A lot of people say, no, I'm not required to take it out, so I'm not going to take it out. And that would be bad thinking, because what you don't realize is that if you take advantage of these large itemized deductions, and they are large if you're over the age of 64, and the extra $6,000 per person, up to $1,200 if your income's under $150,000, that's like free money. So if you're sitting around saying, I don't feel like filing a tax return, I'm leaving my IRA money in there because I don't need it, they're not saying you got to spend it, are they? I mean, people will say to me, well, I don't need that IRA money. Well, you may not need it, but you want to take it so that you can take advantage of all the non-taxability, and then put it into a taxable investment account or roll it over into a Roth. But it's not like you need it. You want to take it because you have so many write-offs that you aren't taking.
Yep.
Right?
Definitely.
All right. Well, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for the news. We'll be back on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. We have a seminar coming up on the One Big Beautiful Bill, and if you're confused, think how we feel. No, I'm kidding. But I mean, there are some wonderful things in the law that if you knew how to take advantage of them, you can increase the refund you get, decrease your tax liability, and we want to help. You can always give us a call at 632-7886. You can join us at our website, Ask the Tax Lady, at egtax.com. We want to help, and of course, we have the seminar coming up in September.
Yeah, a week and a half, the 15th, 16th, and 17th.
And you can register online for that. And if you are interested in learning tax law, we have a phenomenal tax school that starts in October. And by then, the leaves will be falling. And just think about, sitting there learning tax law with a cup of hot cocoa,
Pumpkin spice latte.
You can register online.
Right. Go to egtax.com.
Right.
And click the boxes. Call us at our offices. We can take registrations over the phones. We still do talk to people.
Right. And sometimes it's so frustrating that you would love to just ask a question, but you got to go through this loophole and that loophole and that. Anyway, so we still do talk to people.
Yes.
All right, what do we got here? We're just doing emails today. So next week we'll be back with your live phone-in questions, but this gives us a little opportunity to talk about in depth some of the tax law changes.
Yep. So, we were just talking about seniors, and not that I'm picking on them, but I think Jack is. Are they really taking away gambling losses?
Oh, well, yes. That's starting next year. They're really not taking away, they're capping it, right? So if your income from gambling, and by the way, the 1099-K has been changed again. So unless you had over $20,000 from third-party people or over 200 transactions, are not going to issue a 1099-K, and that's finalized. So you don't have to worry about that. So that's number one. What was the question?
Gambling losses.
That's it. And so, but the other thing is your gambling income is the threshold before they actually report the jackpots has gone up again. So that's
right. That's going up to $2,000.
Right, before they're going to issue anything. So I think to offset that, they're thinking, really, you had more gambling winnings than just jackpots, so we're only going to let you deduct up to 90% of your gambling income. as a itemized deduction.
Right. So if you had $10,000 in winnings on
in
your
jackpots,
in
right?
jackpots, yep, they're only going to let you claim $9,000 in losses on your
Because
itemized
they
deductions.
really think that you had a bunch of little winners and you're not claiming it.
Exactly.
But that's also kind of goes with charity too. They're capping the amount you can take in charity starting in 2026 because they're in 2026 they're letting you take as a deduction $1,000 if you're single and $2,000 if you're filing a joint return over and above the standard deduction.
right. Yep. So if you have it, you don't just
If you have,
automate.
right. It's not like you say, well, they're going to give me 2,000. They're not giving it to you. You would have had to given that to charity, and it's up to 2,000 over and above the standard if you can't itemize.
Correct.
Okay, what else we got here?
Okay, let's see. We got about 10 years ago, right after my father passed away, my mom took her name off the deed and put my sister's and my name on as a title to the property. Since then, she has been living at the family home and has been in great health. However, she just got diagnosed with an aggressive cancer and has been given less than 6 months to live. Oh my gosh. Is there anything we should do to make sure there are no issues left?
Well, so sorry to hear about, your mom. The interesting thing is a lot of times people, especially before, it's interesting how people are learning taxes and they are smarter now than they would have been maybe some time ago. And so people used to think if I put my kid's name on the title, then a nursing home can't get the money, which is true. However, there's another way to do it. It's called a life estate, and then what happens is the mom can stay there, or the dad, or whoever, and the taxes, property taxes, still come to them. They can still pay the property taxes, take it as a deduction, but when they pass away, it gets a stepped-up basis at the fair market value of the date of the death of the parent. In this case, and then therefore when the kids inherit, they don't pay taxes. However, if you put your name on the deed without a life estate, everything's different, right, Chris?
Right, because then it goes back to mom's base. In this case, it would be mom's basis, and there's funky math that you have to do because dad passed away first, so mom inherited half the house, and you got to look at all the capital improvements. So we'll just say mom's value was $100,000. We'll keep it simple, but now the house, because the housing market's crazy, is worth $300,000. Okay, if mom just switched the title, the children go to sell the house after mom passes, they're going to have a tax on $200,000 that they're going to have to pay tax on. But versus an inheritance, they would pay no tax.
So then the thing is, what you might think about doing, and I'll give you the caveat to that, is put the house back in mom's name now.
Yeah.
Because if that's the case, and then she could do, and she could put it to her estate as an inheritance, and then the kids would then get a stepped up basis and wouldn't pay the taxes. Right?
Right.
The only thing that's a problem is at end of life issues, that's probably the most expensive medical time that you're going to get. So you don't really know about what kind of medical expenses mom's going to come up with as she starts transitioning out of this world to the new one. And because you might end up with $1 million in medical bills for end of life, and then if the house is now in the estate and she has a large medical bill, then the house would be used to pay for her medical expenses. So that's the now obviously if there was no large medical expenses, she's got good coverage and it's all going to be paid for by the insurance company, then if you inherit the house, it would save you guys some money. But no one knows what happens at end of life.
That's right. And
the cost involved. So, and so when you think about it, if they have a $200,000 gain, Chris, the maximum they're going to pay taxes on it would be around a little over 50,000 with the state of New York, right? So you have to say, do we want to gamble it and put it in mom's, put it back in mom's name? We inherit it, save 50,000 in taxes. That works out great as long as there's not a great big medical bill at the end and they use the house as an asset.
Right. Right. So
So,
definitely got to look. And the thing is, too, if, and people don't realize all this, if mom actually took her name off the house, put it in the kid's house, it's not the kid's primary residence, there's no star benefit. They lose all those property tax benefits. Where a life estate, it stays in mom's
Right.
name, and she gets the enhanced star, and if there was VA benefits, all those other, disability, deductions from her property taxes, they would have saved.
So then the thing is, if she did a life estate now, I mean, and the other thing is, a diagnosis is just a diagnosis. So maybe what they'd want to do is put the house back in mom's name and have her do a life estate now,
Yeah.
right?
Yep.
Because she might live for 4 more years. Hallelujah, I hope.
Yeah, there's still miracles.
Right. So, and I can't tell you how many times obviously the percentage is low, but there are people that are diagnosed and something happens and they don't pass away. So, and that would be the best way to do it. So I'd suggest you go see your attorney
Exactly.
and see if we can't get her on a life estate. That would mean that even if she had large medical bills, they still wouldn't take the house. There is a phase in. She still retains like a third ownership, but it's better than what it would have been the other way.
Yep. Yes. So.
Okay.
Yep.
But and call us. We'll sit down with you and your attorney. I mean, we could sit down with your attorney, and help do the plan. And you might just say, "I'd rather pay the 50,000 in taxes," which is another thing.
Yep.
If you do nothing.
Yes.
Okay.
Yes. And then, we're going to go back to the previous one you brought up, the 1099Ks. Leo writes in, I own a small business and I contract out some of the work to more contractors. Did the rule change on mailing out 1099s?
Yes, it did.
And it did? Yep.
And it's interesting. You can kind of see the Trumpism in a lot of these things. It's like he doesn't. It's like on the 1099K thing was supposed to go down. You would get a 1099 if you had $600 in third-party pays. Well, now it's back up to the way it was before, 20,200 transactions. So that's how the laws changed. But you almost can see him saying, I really don't want people to pay taxes on this because otherwise it would have been a self-employment situation. So, I mean, it was, remember when we went to the IRS seminar like 3 years ago and that was such a big thing and they spent all this time on the 1099K form?
Yes.
It's just never happened.
No.
Just they kick the can down the road, and now with Trump in there, it's like he just doesn't want people to get stuck paying taxes, so it's like encouraging people to be deceptive, would you say?
Pretty much. But yeah, if Leo here's talking NECs, that used to be a $600 limit,
Right.
and that's now $2,000 limit before you have to mail out a 1099. So it doesn't mean you don't claim the income that you make. You just don't have a tax form to show it. So you're supposed to claim all your income. So if you made the $1,000 under Leo, you won't get a 1099, but you should still put it.
So, and that's correct. So our job is to do a complete and accurate return. So, and really, if you just take all your expenses and you report your income, you've done everything that you can do, and you're not going to get any tax liability or a very small one, and it's the right thing to do.
Yep.
Right?
Yes.
Okay. Let's see. I'm Esther Golias, the tax lady from EG Tax. We're taking your emails this week as opposed to getting phone calls. Next week we'll do phone calls again. And don't forget, we have the One Big Beautiful Bill seminar coming up and our tax school. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. We are talking emails today, and it looks like a lot of it has to do with the one big, beautiful bill because really, they have really changed taxes. And the other thing is, if you're somebody that says, I had an email the other day that somebody said, I don't think I have to file anymore. Sometimes you don't have to file, but you want to file because there are credits in there where they're going to send you money if you file. Isn't that true, Chris?
Yes. Yeah. Well, that's some. We've been getting lots of calls. Even here's an email, Sarah. What do I have to do to get the New York State inflation check? I mean, you got to file a 23 return for New York State to get that $200.
Right. And so doing the return kind of like you. Again, it's a situation where you don't have to file, but you want to file because they're always sending money out based upon your tax return. And so sometimes you just want to file just for those credits, which is a wonderful thing. Like on the IT 229, right?
Right.
If you are a homeowner, but you don't have enough to file, the state of New York was giving refunds. It stopped in 2025, but some of the base years are still open. They were giving refunds of $250 to $350 if you're a property tax owner, a property tax payer, and owner of a home. And if you didn't get those credits, you can still get them.
Right. Yep.
Right.
For 22 and 23.
Right.
Yep. Yeah. So definitely, it may not hurt just to file a return, even though it's zero, because you
Right.
never know what's going to be in the loop.
Okay. What do we have here for our emails?
I just adopted 3 children.
Lord have mercy.
They are all brothers from the same parents. Right now, it's a challenge, but I understand there's a tax credit. They are 5, 3, and 1 in ages. I am a pastor that makes around $80,000 a year. What am I looking at for tax purposes? They were all adopted in 2025.
Well, there was a big change on the adoption credit, right, Chris?
Right. They made it partially refundable.
And so they would get $5,000. Now, is it $5,000 a piece or $5,000 total?
That's a good question. All the fine details aren't quite out yet. I mean, it is $5,000 refundable. The rest is carried forward. But like you said, is that going to be a per person or a per tax return event?
Right.
And that's where the fine
But there's two things that are going to happen. Part of the adoption credit, which is like 17,000, almost let's just say 18,000, just for simple math. They're going to get the 18,000 times 3 kids, or $54,000 there and abouts in subtractions, right? Then there's also the $5,000 refundable portion, so that'll take that down either 5 or 15, depending upon how they're going to come up with the tax law. Needless to say, this pastor's not going to pay any taxes for a long time.
Well, depending on, I mean, he won't pay income taxes.
Well, that's what I'm talking
Right,
about.
right, but he'll
what
have
kind
to
of taxes is he going to pay?
self-employment tax.
You mean as a minister?
Right.
I mean, assuming that that they don't pay it for him, because he has to pay a FIC anyway. But he'd have to do that. But he's going to get he won't pay any taxes. And if he gets the $5,000, that'll cover a lot of his
That will help cover a lot of
self-employment
it.
taxes,
Yes.
right?
Yes. Yep.
So, I mean, and so then what if he says, but I didn't pay anything for this adoption?
Yeah, it's a family group, so it's a special needs child. So they automatically get the full adoption credit per child,
Even if they didn't pay?
even if they didn't pay.
Right.
Yes.
So that's so wonderful. So looking at this, you're going to get a credit of about 54,000, of which, depending upon how they write the law, 5,000 of it's refundable. I don't know if it's going to be capped at 5 or it's going to be 5,000 per child. So that would be a gigantic refundable credit, which then could be used to offset your self-employment taxes, because pastors are considered dual status. So even though they're paid on a W-2, they have to pay FICA on their housing and their wages, right?
Correct.
But even though the housing is tax-free.
Yes.
And by the way, if you are a pastor, we really know taxes on pastoral returns. So, give us a call, because so many times people don't know that the housing is not taxable, but it's subject to FICA. The wages are subject to FICA and income tax, and you can further reduce the FICA by any unpaid expenses that the pastor might incur, such as mileage and ministerial education and things of that nature. So give us a call. EG Tax wants to help.
Yes, definitely.
And really, with 3 new boys or kids in the house, that's
Every little bit will help.
Yep.
Think of all the emergency
Not
room
a little
visits.
bit. I mean, 54,000 is
I
big.
know.
Right.
I know.
Okay, what else we got here?
Morris writes in, Tax Lady, I keep hearing commercials about how steep taxes are once you retire. That really scares me. Are they much more when I retire?
No, I hear those commercials too about, you want to make sure that you don't pay taxes when you retire because your income is less. Okay. That nobody likes paying taxes, but but when you're doing taxes or thinking about taxes, you have to look at the whole pie. So you can save money. Like, let's say somebody wants to roll over $1 million from their traditional 401k to a Roth. Well, it is true, when you start taking the money out of your Roth and you're retired, you won't pay any taxes, right?
Right.
But what did you do when you rolled over?
You paid $400,000 in taxes.
Right. So it's, you just got to read between the lines here. Yeah. Oh, nobody wants to pay taxes when you retire, but if you're paying $400,000 up front, now you only have $600,000 to last you in your retirement. So yes, that $600,000 is going to be tax free.
That's right.
But you just paid $400,000 for the privilege. So don't just buy the goat without having it looked at, right? I mean, it's you really want to, and the standard deductions being so high, even though it might be taxable if you didn't roll it over to a Roth and it was in a traditional, you're going to find that maybe 40,000 of it each year is going to be tax free anyway. So depending upon what would your RMD be on $1 million?
That's what I was just about to calculate out. So at $1 million,
They
at
have to take out
73,
36,000, right? Around 36,000.
30, yeah, about 37, almost 38,000. So
Okay, and your standard deduction if you're married filing a joint return is
right,
like 46.
Yeah.
Right. So, the part that you don't know is how much of this is going to be taxable in Social Security. But let's say 10,000 of it's taxable in the end. You'll pay 1,000 in taxes. Would you rather pay 1,000 in taxes or 400,000 in taxes? Right?
yeah, because how many years would you have to live to pay equal that 400,000?
Right. So right, and then the growth. If you took when you take 400,000 out of your portfolio, guess what? You lose all the income on that 400,000 forever.
That's right.
So it's for some people it may be worthwhile for them, but for most people you really have to think about it. It's better to start contributing to your Roth without doing the rollover.
Yep, definitely.
So, okay,
Yep, and we'll do one more. We got Vince.
we got a quick one.
Yeah. Okay, we'll switch it to Tom. I work overtime all the time. I think this year I had overtime of at least 30,000. I am married and my wife is salaried. We have 3 kids under age 18 and our total income is around 110. Can we expect a savings?
Oh boy, are you? Well, first of all, the kids under the age of 17, the child tax credit went up by $200, so they're going to save $600 right off the bat for that. And overtime, up to $25,000 is a subtraction if you're filing a joint return.
Right.
So, you know, if they're in the 10% tax bracket, they're going to save $2,500 plus the $3,100, right?
Yep.
So they should be happy.
They should be very
And
happy.
here's the thing. You can change your W-4 right now and have them stop your withholding because you do have this money coming. So give EG Tax a call and we'll tell you, or come in person, there's no charge. We will show you exactly how much you're going to save in taxes. And get the money right now. Before the end of the year. Otherwise, you're going to be sitting around in January with this big refund hoping they give it to you.
Right. And
Right.
and also there's a little controversy right now. The devil in the details, they're not out yet, but they don't know, is it the full time and a half that's tax free, or is it just the extra half time that's tax free? So if you normally get paid $20 an hour, overtime you get paid $30. Are they going to give you that full $30 an hour tax-free, or are they only going to give you the $10 tax-free? So you got to stay listening to the show, because
That's
as
right.
soon as we
Because
find
the minute
out,
we find out, we'll let you know.
Yep.
Right? But anyway, so I'm Esther Galias, the tax lady from EG Tax. We have two great events coming up. We have the free Big Beautiful Bill, One Big Beautiful Bill seminar, no charge. Want to just help you, and you can, if you went to somebody else, it's okay. Bring a copy of your tax return, and we'll kind of show you what you're going to save in taxes. That's part of what we'll do in the seminar. And then, of course, if you're somebody that loves people and loves helping people, we have a wonderful tax school that's coming up, and we get our novice tax preparers out of that school for those people that do real well. And so either way, the seminar or the tax school, you can register online by going to egtax.com. Look for the seminar, look for the tax school. And again, if you have questions, give EG Tax a call. But until next week, I'm Esther Galias, the tax lady, with Christopher Fabian. Give us a call off our website at egtax.com. Have a great week. Thanks for listening.